Welcome to Accounting Corner. In this video we are going to talk about an introduction to accounting. We are going to learn 4 parts. 1. What is accounting? 2. Importance of accounting. 3. The accounting equation. And 4. Types of accounts. What is accounting? Accounting is the process of recording, classifying, summarizing, and analyzing financial transactions to provide useful information for making business decisions. It involves recording, keeping track of all financial transactions in a systematic and detailed manner. This is usually done through journals and ledgers. Classifying, organizing financial data into categories to make it easier to analyze. This involves grouping similar transactions together. Summarizing, preparing financial statements such as income statements, balance sheets, and cash flow statements. These provide a summary of a company's financial position and performance over a specific period. Analyzing, interpreting the financial data to understand the financial health of a business, identify trends, and make informed decisions. Importance of accounting. Accounting is the backbone of any business, providing essential financial insights that guide decision-making and ensure compliance. It helps track performance, manage resources, and build trust with stakeholders. Decision-making provides critical financial information that helps managers, investors, and stakeholders make informed decisions. Regulatory compliance ensures that a business complies with financial regulations and standards, such as Generally Accepted Accounting Principles, GAAP, or International Financial Reporting Standards, IFRS. Performance evaluation helps in evaluating the financial performance of a business over time, identifying strengths and weaknesses. Budgeting and planning assists in creating budgets and financial plans to manage resources effectively and achieve business goals. Investor relations builds trust and transparency with investors and stakeholders by providing accurate and timely financial information. The accounting equation. The accounting equation is the foundational principle of double-entry accounting, representing the relationship between a company's assets, liabilities, and equity. It is expressed as assets equals liabilities plus owner's equity. This equation ensures that a company's financial statements are balanced, meaning the total value of what the company owns, assets, is always equal to the total value of what it owes, liabilities, plus the owner's stake in the company, owner's equity. Expanded accounting equation. The expanded accounting equation is an extension of the basic accounting equation. It provides more detailed insights into the components of owner's equity. It is expressed as assets equals liabilities plus equity plus revenues minus expenses. This equation shows how different transactions affect the financial position of a business and provides a comprehensive view of the company's financial health. As shown in this illustration, the components of the expanded accounting equation are assets. These are resources owned by the company that have economic value and can be converted into cash. Liabilities. These are obligations the company owes to others. Owner's equity. This represents the owner's or shareholders' residual interest in the company after all liabilities are deducted from assets. Revenues. The money a company earns from the sale of its products and services. And finally, the expenses. These are the costs that contribute to a company's overall cost of doing business. In Part 4, we are going to illustrate these components in more details. Importance of the accounting equation. Balance sheet foundation. The accounting equation forms the basis of the balance sheet, one of the key financial statements. The balance sheet is structured around this equation, showing that the sum of a company's assets is always equal to the sum of its liabilities and equity. Double-entry system. The equation underpins the double-entry bookkeeping system, where every transaction affects at least 2 accounts. For instance, if a company borrows money, increases liabilities, It also increases its cash, assets. Financial health. By maintaining the balance dictated by the accounting equation, companies can ensure accurate financial reporting, which is crucial for assessing financial health and making informed business decisions. Example of the accounting equation. Suppose a company buys a piece of equipment worth $10,000 by taking out a loan for the full amount. In this case, assets increase by $10,000, the value of the equipment. Liabilities also increase by $10,000, the loan amount. The accounting equation remains balanced. Assets equals liabilities plus equity. $10,000 equals $10,000 plus $0. Understanding and applying the accounting equation is essential for anyone involved in accounting, as it ensures that every financial transaction is accurately recorded and the financial statements remain in balance. Part 4. Types of accounts. In accounting, accounts are categorized into different types based on their role in the financial statements. These accounts are essential for recording, classifying, and summarizing business transactions. They are classified into assets, liabilities, owner's equity, revenues, and expenses. Assets. Assets are resources owned by a business or individual that hold economic value and can be converted into cash or used to generate income. They are crucial for the operation and growth of any organization. There are 5 types of assets. Current assets. Easily convertible to cash within a year, including cash, inventory, and accounts receivable. Fixed assets. Long-term resources used in operations like buildings, machinery, and equipment. Intangible assets. Non-physical assets such as patents, trademarks, and goodwill that provide value to the business. Financial assets. Investments in stocks, bonds, or other securities that can yield financial returns. Natural resources. Assets like land, minerals, and forests that can be utilized for economic gain. Liabilities. Liabilities are financial obligations or debts that a business or individual owes to others, which must be settled over time through the transfer of money, goods, or services. They represent the claims of creditors on the assets of the business. There are 5 types of liabilities. Current liabilities. Debts or obligations due within 1 year, such as accounts payable, short-term loans, and accrued expenses. Long-term liabilities. Debts or obligations that are due after 1 year, including long-term loans, bonds payable, and leases. Contingent liabilities. Potential liabilities that may occur depending on the outcome of a future event, like lawsuits or warranty claims. Operating liabilities. Obligations related to the day-to-day operations of a business, such as salaries payable and utility bills. Non-operating liabilities. Financial obligations not directly tied to core business activities, like interest payable on loans. Owner's equity. Owner's equity represents the owner's claim on the assets of a business after all liabilities have been deducted. It reflects the net worth of the business and is the residual interest in the assets of the company after settling all debts. There are 5 components of owner's equity. Capital. The initial investment made by the owners into the business. Retained earnings. Profits that have been reinvested in the business rather than distributed to owners or shareholders. Drawings or withdrawals. Amounts taken out of the business by the owner for personal use, reducing the overall equity. Additional contributions. Any extra investments or capital injections made by the owners into the business over time. Reserves. Portions of retained earnings set aside for specific purposes, like future expansions or contingencies. Revenues. Revenues are the income generated by a business from its normal operations, typically through the sale of goods or services. They represent the top line of a company's income statement and are crucial for assessing the business's financial performance. There are 5 types of revenues. Operating revenues. Income earned from the core business activities such as sales revenue for a retailer or service fees for a consulting firm. Non-operating revenues. Income generated from activities not related to the core operations, like interest income, dividends, or gains from the sale of assets. Recurring revenues. Regular and predictable income such as subscription fees or rent received. One-time revenues. Income from events that are not regular, such as the sale of a subsidiary or a windfall gain. Gross revenues. Total revenue before any deductions like returns, discounts, or allowances. Expenses. Expenses are the costs incurred by a business in the process of generating revenue. They represent the outflow of resources and are essential for the day-to-day operations of the business. Expenses are deducted from revenues to determine a company's net income or profit. There are 5 types of expenses. Operating expenses. Costs related to the core business activities such as rent, salaries, utilities, and marketing. Cost of goods sold (COGS). Direct costs associated with producing or purchasing the goods that a business sells, including materials and labor. Administrative expenses. Overhead costs related to the overall management of the business, like office supplies and insurance. Non-operating expenses. Costs not directly tied to core business operations such as interest expenses, taxes, and losses from the sale of assets. Depreciation and amortization. Non-cash expenses that allocate the cost of tangible and intangible assets over their useful lives. Accounting basics. Your financial foundation. And there you have it, your introduction to the world of accounting. Let's quickly recap what we've covered. We defined accounting and explored why it's crucial for businesses and individuals alike. We broke down the fundamental accounting equation. Assets equals liabilities plus equity. And we examined the 5 main types of accounts: assets, liabilities, equity, revenue, and expenses. Remember, these concepts form the foundation of all accounting practices. Whether you're running a business, planning your personal finances, or pursuing a career in accounting, understanding these basics is your first step towards financial literacy. In our next video, we'll dive deeper into financial statements, starting with the balance sheet. Make sure to subscribe and hit the notification bell so you don't miss out on our upcoming lessons. If you found this video helpful, please give it a thumbs up and share it with anyone who might benefit. Drop your questions or topic suggestions in the comments below. I read every single one. Thanks for watching, and I'll see you in the next video where we'll continue our journey into the fascinating world of accounting.